If you told me it would hit 200 bucks this year, I wouldn't be surprised. I'm not saying that's where it's going, but it wouldn't shock me at all. And look, if you take gold right now, which is at, let me see, roughly 49.40 and divide it by 7, which is the geologic ratio, its real ratio. I'm not saying it's going to get there, but 49.40 divided by 7 is $705 an ounce. All right. So 705 versus where we are. If you take it right now at 96, somewhere in between, could it be? Yeah, why not? If that's what it's coming out of the ground at, if we are on our 6th year of structural deficit between supply and demand, if it's now critical, if China is going to restrict exports as the world's largest refiner of doré, as the European Union makes it critical, as there is a realization that it is critical, and don't forget about the monetary side. How high could it go? Well, I guess you could say somewhere between here and 700. Wouldn't surprise me.
Silver hitting $200 this year is becoming a realistic expectation, but the true potential lies in the geological ratio. With gold trading near $4,940, a return to the natural 7-to-1 extraction ratio implies a staggering valuation of $705 per ounce. Andy Schectman, president of Miles Franklin, emphasizes that while $705 seems extreme, it is grounded in physical reality. He points to a 6th year of structural deficit, in which demand relentlessly outpaces supply. Schectman argues that with China potentially restricting exports as the world's largest refiner, and the EU designating silver a critical mineral, the market is primed for a violent repricing. The suppression is breaking, and a move anywhere between current levels and that $700 geologic target would not be shocking given the monetary and industrial drivers. The combination of monetary demand and industrial necessity is creating a perfect storm. If the metal is coming out of the ground at a 7-to-1 ratio to gold, the current price disconnect cannot last indefinitely. Investors are urged to consider the upside potential as global powers realize the metal's criticality. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
All you need to see is the amount of deliveries coming on the COMEX, and I can make it very simple. When I started talking with you about this stuff several years ago, it was about the central banks purchasing gold and the repatriation from the Bank of England and the New York Fed. But now it's progressed to massive deliveries coming on to the COMEX market. Entities standing for delivery for billions and billions and billions and billions every single month for going on 16 months. At this level, that's all you really need to see. To me, that's all that is relevant. The people who are standing for delivery for literally in December, as an example, the largest delivery of silver in the history of the COMEX market in the month of December, somewhere in the neighborhood of 68 million ounces of silver. Who's standing for delivery for 68 million ounces of silver? Every month, 3, 4, 5 million ounces of gold or more. This is going on repetitively, and there is no one talking about it. To me, there's nothing else you need to see. So these pullbacks that we see, like we saw this morning, are, to me, not anything other than a gift. Now, it's hard for someone to really, look, short-term caution, sure, anything that's gone up this fast. Long-term bullishness, absolutely, they can coexist together. But I think that when you look at a market like this and see the deliveries, see the rate hikes in margin that do nothing but knock it down for a day or two, shaking the weak hands off, then it goes right back up, seeing the lease rates elevated forever, seeing the arbitrage in China at a $8 or $10 difference in price on silver. All of this stuff, to me, would have destroyed the price of gold and silver in years past, like it did in 2011, where they jacked the margin rates up and it never came back. Took 15 years. This market is laughing it off. The people standing for delivery do not care about margin. They don't buy on margin when they're spending billions and billions and billions of dollars. And I just think that that is all you need to know. So when we see a pullback, to me, it is not about a whole new bunch of supply that has been dumped onto the market. It is about unwinding of leverage and of speculation and being shook from a position of rising margin responsibility and the selling that incurs as a result of it. But it always used to, when that happened, it would just fall and fall and fall and wouldn't come back. And now all of a sudden, it's like a speed bump and it comes right back. So to me, you don't need to see much else than to see the demand that is coming at the very highest level here in the United States. so far in January, which is not a delivery month, I don't know, somewhere around 40 million ounces has already been delivered. I haven't checked it, but I would assume that's about where it is. It was in the upper 20s last week. So even if you take the upper 20s and you add it to the 64, 5, 6 million ounces that was delivered in December, the largest ever, you're at roughly 100 million ounces in the last 45, 50 days that have been delivered. Now, is there any, I think, coincidence maybe that the government classified silver a critical mineral? And they just passed a law saying that the government will put price floors underneath critical minerals within the next 90 days. I think that there is this fine line between, could it be Samsung, Sony? Could it be the government not telling us? If it's done under the Exchange Stabilization Fund, they don't need to get congressional approval. They don't need to tell Congress up front because it's for national security. Well, silver has now been made a priority for national security. And so I guess all I'm trying to say is that it's incredibly unusual, and the people at that level who are bringing in that kind of money, who have been following what the central banks have been doing, in my mind, that's all you need to see. And you can see that this is not a mania. It's not a mania because even though we're doing tremendous volume in business, it's not the volume that we saw during Silver Squeeze, where everyone was buying little bits, even a couple $1,000s worth, where the public was starting to expand. Now, these are the people who we've worked with for a long time, or the people who have been watching you for a long time, or me or others, who are finally saying, it's time to actually do something meaningful here. And we're seeing much larger orders. Our average order size right now is exponentially larger than it's ever been. These are people who are concerned, who are aware, and are seeing the same things that we're talking about, but they represent a tiny portion of the public. The public is still vastly unaware of this, and that's due to the fact that how do you explain that we have gold and silver at all-time highs, and it's nowhere to be found on the mainstream media? It's not on 60 Minutes or on the cover of any newspaper.
The precious metals market is witnessing a historic anomaly where margin hikes, once the ultimate weapon to suppress prices, are now shrugged off as mere speed bumps. Data confirms that huge entities are standing for delivery of billions of dollars in physical metal, draining the COMEX at a rate never seen before. In December alone, a record 68 million ounces of silver were delivered, followed by continued heavy volume that totals roughly 100 million ounces in under 50 days. Market analysis identifies this phenomenon as a silent takeover by well-informed capital rather than a retail frenzy. Unlike previous squeezes driven by small investors, average order sizes have grown exponentially, signaling that high-net-worth individuals and potentially government bodies, operating via the Exchange Stabilization Fund, are securing strategic stockpiles. This accumulation coincides with the government classifying silver as a critical mineral and passing legislation to establish price floors within 90 days, effectively guaranteeing a repricing under the guise of national security. Let's get back to the interview.
We're getting close to that moment where you can start thinking about swapping your silver to gold. We're at about a 50-to-1 ratio. I started telling people about that when it was 100-to-1 in March of 2020, and it's stayed. I guess it stayed irrational longer than a lot of people really like, but it's starting to move back to where it should be. And I think if you bought in 2020, you could start by maybe like layers of an onion, peeling some off and trading some silver to gold right now. But again, the argument against it is that it's an asset that is finally maybe going to find global price discovery after never being allowed to do so. And how low does it go? I guess we shall see. I don't know exactly how low the ratio goes, but I would start looking at it very seriously right now with some. And as we get into the 40s and below, then yeah, you continue to do it. Granted, it's coming out of the ground at 7-to-1, and it is now seemingly trying to find real price discovery. As far as the price goes, we talked about it, and I said months ago, like, if you take technical analysis, again, in a rigged market, how valid is it in terms of where it stops? But I did say publicly that I think 96 is easy, because you take the top of the cup in 1980, the bottom of the cup in the early 90s, that's $4. The difference is 46. When it finally makes the top of the cup and then the handle back above 50, you add that to the top, that's 96. This is where the breakout, anyone using technical analysis would say we are. This is why you're getting all the, well, it's, technically you might want to sell it, but I don't think so, because now it's national security. Now the government's buying it. Now there's a floor underneath it. Now it's being drained from the exchanges. Now we are beginning to see, through delivery by very sophisticated people all around the world, not just in North America, but in India and in China and so in Saudi Arabia and Russia, they're all saying, this is what we're going to do. We're just going to gobble it all up. It's a race to get it. Where does it stop? I think a lot higher than people think. Michael Oliver, who uses momentum analysis, says 200-300. Wouldn't surprise me. I mean, I guess it wouldn't. I guess we'll see. I don't buy it to become wealthy. I buy it because it is wealth. You're beginning to see that play out again and finally accentuate itself after being held down for literally decades by the West. Now all of a sudden it's trying to find what its real price, and I think it'll go much higher. If you told me it would hit $200 this year, I wouldn't be surprised. I'm not saying that's where it's going, but it wouldn't shock me at all. And look, if you take gold right now, which is at let me see, roughly 49.40 and divide it by 7, which is the geologic ratio, its real ratio. I'm not saying it's going to get there, but 49.40 divided by 7 is $705 an ounce. All right, so 705 versus where we are. If you take it right now at 96, somewhere in between, could it be? Yeah, why not? If that's what it's coming out of the ground at, if we are on our 6th year of structural deficit between supply and demand, if it's now critical, if China's going to restrict exports as the world's largest refiner of doré, as the European Union makes it critical, as there is a realization that it is critical, and don't forget about the monetary side. How high could it go? Well, I guess you could say somewhere between here and 700. Wouldn't surprise me. You get that high? Sure. That's overly optimistic. But if you said $200, is that really that crazy? I don't think
$200 by when?
By the end of the year? Who would have thought we'd get to 100 as fast as we have? I mean, we're just an eyelash away. Now, I will say this. If I were the banks that were trapped, I would try to knock it down at about 98 or 99. I would, because that's how everyone waiting for 100, that big round number. And then everyone that falls out, you scoop it up and it shoots right back through it again. But 150, within the next month or two, at the rate we're going, sure, why not? I'm not the kind of person that makes these guesses or projections. Just looking at what we've seen so far, in May it was $30-some.
Right.
And now we're $90-some. So again, it's just being set free from being caged for so long.
As the gold-silver ratio compresses toward 50-1, seasoned investors are beginning to execute a strategic swap, peeling off silver profits to accumulate gold like layers of an onion. This move aligns with a massive technical breakout. The long-term cup and handle formation, dating back to 1980, projects a measured move to $96, a target that is now within striking distance. However, experts warn that selling too early could be a mistake given the new national security floor under the price. With governments globally draining exchanges and the geometric ratio suggesting a theoretical fair value of $705, a move to $200 this year is viewed as conservative. While trapped banks may attempt one final washout near $99 to shake out weak hands, the structural deficit ensures that any dip will be aggressively bought, launching the metal toward $150 and beyond as it finally finds true price discovery. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.